We're about to see probably the greatest run on new homeowners entering the market than we've seen since, like, I believe it's the 50s.
Correct.
You know, right now, the average age of a first-time home buyer, according to NAR, the National Association of Realtors, is 33. The next 5 to 6 years sees a significant increase in the number of births in our country. And so if that first-time home buyer stays at around 33, hey, listen, real estate agents, lenders, it's a great time to be in the business. Welcome to another episode of the Contacts to Contracts podcast. I am Brian Lovell, as always, here with our amazing co-host, Mr. John Jones.
What's up, Brian?
What's up, brother? How are you?
How you doing? Looks like you enjoyed some sun this weekend.
I got into a little sun this weekend, yes.
All right.
Yes. You'd think after living in Florida my entire life.
Sunscreen, no, right?
I did not put on any sunscreen.
Well, you're at that point in your life, you probably figure throw it out. Who cares?
I was even warned and I declined.
Wow.
And, so those of you who are not in Florida, or maybe in Florida and you need some advice, even if you're under an umbrella,
it comes and gets you.
You can get sunburned.
Yep.
So, yeah. Good thing it doesn't hurt.
Okay, that's good.
So, John, you kind of put together the topic for today. We're going to talk a little bit about, are we currently in, or could there possibly be a housing bubble in our real estate future?
Yeah, I'm kind of excited to talk about it and maybe lay out, 2 or 3 things why I personally don't think we're in a bubble. We'll start off with, we've changed in our industry from the previous 2005, 6, and 7, the type of loans that we're making to the consumer and how easy or not easy at this point it is to get a mortgage. So I think credit and how they've tightened, with doing away with subprime essentially and stated income, stated asset, no doc loans, I think that's going to be a huge factor in keeping us out of that bubble.
Yeah, I mean, it's definitely a different world than it was back in 2008 and through 2010. And just 1 second before we go too deep into this, why do you think people are concerned that there might be a bubble?
Well, I mean, if you're in real estate right now, there's no inventory, right? An incredible low amount of inventory. Consumers are multiple offers on homes. It virtually doesn't matter what part of the state you're in. As you know, that a home comes on the market and you probably have 15 or 20 people bidding on that home.
Right now, I don't know that it matters where in the country you are.
Right.
We're seeing all over through our contacts throughout the industry nationwide and, through different media outlets that it's definitely a seller's market. I mean, you're seeing homes that are selling for well over ask. It's a market that, in my opinion,
hence speculation of a bubble, right? When people get over exuberant and they want to stretch the dollar, so to speak, and they're willing to pay 40, 50, 60,000 higher than maybe even appraised value.
Yes.
To a lot of us, that gives us a little angst, right? Yeah. In the business, we're thinking, is this like, gold rush speculation? What's happening to our market, and are we going to lose the stability that we've had over the last decade?
So the speculation out there, then, to just give some clarity to it, is that with everything that we're seeing right now in the market, could we see home prices deteriorate down the road? And by deteriorate, I mean, instead of having appreciation, what's the opposite of appreciation?
Depreciation.
Depreciation.
Depression.
That's a good thing it's a good thing you're the co-host.
Yeah, I mean, great point. We don't know where pricing is going to go from here, and let's say 12, 24 months out. But a big factor is affordability today compared to 10, 12 years ago. Interest rates back in the last boom and then bust. Rates were at 6+%. Today we're still locked in. Your affordability is far greater today for a homeowner than it was 12, 15 years ago because of those low rates.
Yeah, to that point, I saw a statistic earlier this week, and I apologize, I don't remember where I saw it, so I can't give due credit. But they said that this is the 7th best affordability market that we've ever been in as a country. Now, I want you to think about that for a minute. It's the 7th best. That's based on incomes of where we're at in 2021 and prices of where we're at in 2021. The reason, because prices are going up faster than incomes, right?
Correct.
But the reason it's the seventh best is because of low interest rates.
Right.
You know, and it makes me think too, and I'm sure we're going to touch on this in a minute, but you know, we're seeing record appreciation. Can you imagine what it would be like if we didn't have appraiser independence?
Oh gosh.
Right?
It could be. We could be in trouble.
So go back to like pre-2007 when you know
made the phone call.
As a loan officer, you just made the phone call.
Right.
Hey, listen, Mr. and Mrs. Appraiser, I'm going to need this property to appraise for
point.
X
Right.
to make this deal work. And hey, by the way, if you can't make that happen for me, I'm probably going to go to the next person.
Yeah, and
Right?
and we're starting. You know, we're having some appraisals come back less than asking or offer price. And you bring up a great point, because that phone call to the appraiser that we were able to make that we can't make today because of the changes. You know, we're not able to cross out of one neighborhood or subdivision to go to another.
Correct. Yeah.
You know, to maybe find a comp or stretch a comp or a sale price. We saw a ton of that back in 06 and 07.
Yeah. So today we have appraiser independence, meaning that, you know, the loan originator nor the real estate agent can pick who the appraiser is. It's you know, by luck of the draw, so to speak, right? And then the second thing is, to your point, there have been some guidelines put in place for things like bracketing of appraisals and you know, how far out they can go from the subject property to find a comparable.
Right.
But I mean, you think about it, if we didn't have appraiser independence, this would be wild.
This would be, you know, a lot further north up than where we're at.
This would be
now.
wild. I think my bigger concern, and again, I know we're going to answer this question here in a minute, but one of my big concerns for consumers right now, specifically buyers, is I think with the market that we're in, we're taking away a segment of the buyer community right now, and that's going to be mainly FHA buyers are probably having a difficult time getting their contracts accepted because
Correct.
they likely don't have the available assets for that over ask bid, right? And also a lot of times, you know, FHA allows for up to 6% seller concessions. And you know, seller going to take a concession right now.
Not
in
a
this
chance.
market. Not a chance, right? And so a lot of the reasons sometimes that FHA buyers go into choose FHA as their financing is because of those
Limited funds to close.
Yeah, in the concession allowance, right?
Right.
So yeah, that down payment assistance programs, you know, things of those sort. I was talking to a loan officer this weekend, and we were having a conversation about, you know, what are some of the things that you're having to do as an LO in this market to help your buyers win bids, you know, working together with your real estate partner, you know, the buyer's agent. And, you know, you're getting multiple offers coming on properties. It could be 10, 12, maybe even more. And you're trying to weed them out. And what he was sharing is like, hey, I think one of the things that listing agents really have to look at too is who is the loan originator or the lender that is on that letterhead. And so he gave an example to me of, you know, agent calls and says, hey, our offer is up against one other. Like they've narrowed it down to these two. Can you think of anything to help me try to get our buyer's offer accepted? And he says, well, hey, do you know who the other lender or who the other loan officer is? And they were like, yeah, it's blah, 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 blah. I don't remember what it was. So he says, give me 10 minutes. Hold on, I'm going to give you a call back. He goes on to NMLS, Consumer Access. He looks up the loan originator.
Finds out how long they've been
like 8
in
months,
the business.
Like 8 months in the business.
Yeah.
Okay. And I don't remember what their previous employment was, but it wasn't anything to do with financial industries. So he prints it down, scans it over, sends it to the agent and says, use this.
That's dirty. I like it. Yeah, that's smart.
That's what you got to do.
Yeah.
And by the way, this is a loan officer with 19 years experience, has closed thousands of loans. You know, I'd put my money on that guy.
Yeah, absolutely. Winning the battle. I mean, sellers control the market. We've seen and we know sellers and the listing agents are telling buyers and buyers agents, if this doesn't close, we are not going to extend, and we are going to the next offer, which may be a backup offer that's higher and better.
Yeah.
Likely. You know, so they're not going to have any sympathy with a lender or not a local lender that says, hey, I need a week or two more to get this deal done. they're likely to kill the deal and move on.
Yeah, yeah. So kind of getting back to the question, the question was, will there or are we going to experience a housing bubble? And our feeling is no, and we're going to give you a couple of facts to try to back that up. So, the first one we were talking about is the credit worthiness of our borrowers. Can you dig into that a little bit?
Well, I mean, if you were in the industry back 15 years ago, I think it was probably about 50%. We were doing loans that were combination loans, 80-20s, meaning people were buying homes with no money down. Never mind FHA. In fact, FHA was something that I prided myself in as an originator. And the buyer back then had to put 3% down. Seller would pay 6%. That went away.
Yeah.
Buyers were coming in saying, I want to put no money down. And that became a normalcy, whether you had money or not. It just became the thing to do as a combination 80-20 first mortgage, second mortgage. The second mortgage might have been fixed at a rate for 2 years, 3 years, and then became adjustable. And rates again were at 6%, 7% back then.
Yeah.
The seconds were up at 8, 9, 12%. So they really weren't qualified to make that payment. Combining all that, we had stated doing that, or no doc type of loans where we weren't necessarily verifying the ability to repay.
Yeah.
And I mean that's no longer the case. And thankfully, as a homeowner and an investor, I mean that's great for the rest of us. And going forward, that we know that these people that are getting mortgages today, they qualify.
Yeah.
They have true income that they can repay the loan.
Yeah. So basically, today, as lenders overall, there's credibility, right? So they've got higher credit scores. They have skin in the game. We're vetting them a whole lot more than we used to. So what happened back then?
Really vetting them.
Yeah.
I mean, it's, as we say in the industry, it's, I like to tell people, if you haven't had a mortgage or gotten a mortgage in 15 years, well, it's going to be a lot different. We're going to dive in deep, again, for the benefit of all of us as a whole, in our industry and housing values.
Yeah. Yeah. So back in the day, to kind of hammer down this point, John, we would put folks into loans that their payments could increase or could change, and get them into a place where the home was not as affordable as it once was. So now not only can I not make my payment necessarily, but if you remember in 2007 through 2010, we had some depreciation of properties, right? And part of that is because then we truly got into a buyer's market. Just none of the buyers qualified. They had
right.
short sales, foreclosures, bankruptcies, whatever it may be, right? And so this time around, what could happen if we see that is they'll still be able to afford the payment.
Correct.
Right?
Yeah. So you, just to fast forward or fast back, 07, 05, 6, and 7, different how it is today. Today we're in a frenzy, right? People know real estate's increasing in value. They've seen it, and we're getting year over year 18, 20% spikes in prices in different markets across the country. Everybody wants in the game. Right, we see groups of investors in the game. People are going crazy, bid over ask. We just talked about. However, you can't get that same no doc loan that you got back in 05, 6, and 7.
Yep.
If we had that still today, we'd be in a whole lot of trouble.
Yes.
Because those folks would be out in a frenzy trying to grab up these properties. Because the premise back then, and the premise still today for a lot of people, is if it's going to go up 20%, that's a pretty darn good investment.
Yeah.
If I buy something, even if I really can't afford it, if I hold it for 2 years and it goes up 30 or 40%, that's pretty darn good. If I did no money down on top of that, I've really done great on my money.
Yeah.
I took a zero and became a hero. I mean, making 60, 80, 100 grand. And that's exactly what happened, a dozen years ago.
And I think one of the things that got folks in trouble on that too, and I know you're prepared to talk about this, is we were using our homes as ATM machines.
Yes.
Right. So we were doing tons of cash out refinances. Today, your max loan to value on a cash out refinance is, I believe, either 75 or 80%. Is it 75?
75 to 80%.
It's 75 to 80% max loan to value on a cash out refinance. 15 years ago,
take it all.
Take it all.
Take it all. Well,
right?
I mean, and honestly, we had lenders that 125% of the value of your home. So you had, let's say, a 90% first mortgage. They'd loan you a second mortgage 25% above current appraised value. It was, dude, it was nuts. I mean, it made no sense.
Yeah, so what was happening then was we were also at max loan to value, right? Whereas
Very low
today,
equity.
if somebody got into trouble on their home, they'd be able to sell it. They would still have equity in the home to be able to get out from under it.
Yep.
But when you're
upside down
and you're completely maxed out, you're not left with a whole lot of options.
Yep.
Right. I know we had a statistic we were going to share. So let's use 2006 as an example. Folks took out $312 billion in equity. That's just the equity portion.
Right.
And and cash out
right.
refinances.
Yeah. Boats, jet skis.
Yeah. Fast forward to 2019, only $74 billion. Mm-hmm. And the difference is the tightening of the guidelines there on the cash out refinance.
Yeah, I mean, I think that number, the $312 billion you talked about, a lot of that speculation was cash out to go and buy another property, 2 or 3.
Sure.
I mean, I had handfuls of investors, guys, wannabe investors that were buying 2-3 units in a building, new constructions, kind of speculating that by the time that building or that condo was finished in 18, 24 months, they'd resell it at a profit and, essentially never have to make a payment.
Yeah.
Didn't work out. I mean, it was musical chairs, and when the music stopped, that was it. I think that was about July of 2007. We all know where we were if you were originating.
Yeah, I was a rookie.
Yeah. And then what they put into place, what we call the implodometer?
Yes.
What lenders were
yes,
going.
the implodometer.
Yeah.
That started the summer of 2007.
Yeah.
I'd been in the business for 3 months. I didn't know what an implosion was.
Timed it. You're like, where are all these lenders going? These investors are they're dropping off. So that was crazy.
I really think that part of, for me at that time, like not knowing I didn't know what I didn't know.
Right. What did I get into this for?
And so I just put my head down and kept going. But, some of these folks who, I mean, we know tons of people who toughed it out through that time.
Yeah. One of them.
Yeah.
Just
toughed it out through that time and just crazy.
Beg and borrow. Yeah. Beg and borrow.
Figure out a way to win, right?
So second, why we don't think there's a bubble, or at least I don't think there's a bubble, and a lot of people are talking about this, is housing stats and the supply of housing. So, again, going back, previous bubble, builders, new construction, speculation, just throwing in subdivision after subdivision, build it, they will come type of philosophy the builders had. To me, there weren't end users in this game. There were a lot of people like you and I and other folks that were buying 4 and 5 of these units at a time, waiting for them to be done, and then hopefully flipping and selling
Sure.
them. Where today the builders have drastically pulled back, and they're not building essentially enough homes, new homes, to meet the inventory.
So I think a couple things going on there. Well, one, the margin on new construction is the same whether a builder builds a $200,000 home or a $500,000 home, right? If the margin is the same, if I invest $200,000 and I can make $300,000, or if I can invest $400,000 and make $200,000, hopefully I got the math right there. If you have the capital to do it, you invest more to make more, right? And so I think there's a segment of buyer that's been left out of the market, or that's currently being left out of the market, and that's the new home buyer. There's not as many homes available for them to buy as is needed, right? And that's why you're seeing a lot of what you're seeing. And I think for back then too, John, you would see just a ton of tract homes being built, massive developments, building hundreds, if not thousands of homes at a time. And I think builders have gotten a little bit more savvy. Like they're not sitting on tons of inventory.
They're not moving forward until the contract's signed.
Correct. They got a couple of spec homes maybe up out of the ground, but there's not just tons of homes waiting for somebody to move into. And then I think, let's also talk about COVID. A year ago,
brakes were put on. They
shut down for 6 to 8 weeks.
Right.
No homes being built, and so today there's
housing's like toilet paper a year ago.
Yes.
There's no supply.
Yes.
If you're looking to buy any product now, whether it's an appliance, for example, right, when there's a shutdown, right, that consumer supply chain shutdown, I mean, it takes months, if not years, to get caught back up to where that lag was.
Yeah.
Another thing I think to bring up is just the material cost. We talk a little bit about inflation, right? We don't want to hear about that, but everywhere you go today, I mean, almost any item, whether it's gas, whether it's groceries, a piece of plywood, found out at $26 for a sheet of plywood. I mean, it's nuts.
Yeah.
In builders, the cost to build and construct the new home. In fact, we have a local loan officer that's under construction, and he's the one that he signed the contract just 4 months ago. They've had now their third price increase. In a 4-month period, and the builders have to be super sharp now, because week after week those material costs are going up. They know their fixed labor costs; they can manage that part.
Yeah, but material is a little harder.
It could get to the point where they have to slow on constructing homes because the end product might not be, sellable at that price to cover the build.
Yeah, you're absolutely right. The inventory, not just new construction, but total inventory, is at record lows right now. When we entered the housing bubble of back in the late O's, 07, 08, 09, we already had good inventory. We're at what?
Right. Eight and a half months worth of inventory.
Right.
Where
So
today we're about 3 months.
At the time that the bubble started, we were at 8.5 months. Today we're at 3 months of inventory. So 8 months inventory turned into 12 months inventory pretty quickly.
Right.
Right now, we would love to see it move from 3 to 6.
Correct. Yeah. I mean, that would be a big help for everybody in our industry.
Yeah. I mean, there is definitely some buyers and agents out there who are, they're earning every shekel.
Like you said, if you're a down payment assistance or unfortunately FHA, maybe even VA, USDA, it's a challenge right now.
You're probably out of the market. I will say, I always try to defend VA, but because a lot of people have some misconceptions. It's an amazing loan product, by the way, agents. It's not any harder to get a VA loan approved than any other loan. That was like a gazillion years ago. Right. So moveon.com from that. But the VA buyers typically have money, right? It's just that loan doesn't require them to put any down. So
why would you?
Yeah, so they very well, might be able to.
No money down, no monthly mortgage insurance.
Yeah, but they might have the cash to go over ask or whatever. So don't put your nose up at that pre-approval letter that comes in with VA financing on it.
Yeah, I like a strategy you mentioned earlier, and we talk about that for a minute. But you talked about if you are a buyer out there looking to make an offer, and you mentioned cash.
Okay, yeah.
For example, but rather than trying to stretch and put 20-30% down, right, you have some strategy on how to win a deal, maybe if there is a potential issue with an appraisal and an escalation clause.
Yeah, so, I think that, in the finances that we're seeing currently in the market that we're in, and with interest rates as low as they are, we've kind of been preaching, hey, take out a loan for as much as you can. That cash is king. And so what I mean by that is, if you're a buyer that's got 20% to put down, I actually recommend you don't do that, right? And it was before this market, but I'll explain why on both of them. When interest rates are 3%, 3.25%, that money's almost free to borrow.
Correct.
Right? And, for you to spend all of the cash that you have to go into a home, I think is a mistake, because you never know when you're going to need that cash down the road. So I would get the largest loan.
I can tell you when you're going to need it. If you're a new homeowner, the first 3 to 6 months.
Yes.
You can bet that there's a lot of projects that come up when you buy a home.
Yeah, furniture and all that stuff.
Right.
So, I've always been a proponent of, hey, get a loan for as much as the bank will allow you to, and keep the rest of the cash. It's like, anybody who's bought a car recently, and maybe not recently, but a year ago, all these dealerships were offering 0% financing on a lot of these cars. Like, even if you had the $60,000 to go,
Why
would you do that?
Exactly.
They're giving you money for free.
For free.
Right?
Right.
And, so here's my thing with it right now in the market that we're in is, instead of putting 20% down on a property or 30% down or 40% down, whatever it is, we're seeing a lot of buyers in the market right now who are move-up buyers, meaning that they're selling a home. Maybe they're net $80,000, $100,000 or whatever that they've got to invest in the next home and to buy down the mortgage. My recommendation is go with the lowest mortgage possible. Right now, you can get a conventional loan with 95% LTV. By the way, mortgage insurance is pretty cheap too. So even if you chose not to do monthly, if you did upfront MI, like if your credit is horrible, you might pay 2 points to buy out the MI upfront. So now you're putting 7% down, no monthly mortgage payment, no monthly mortgage insurance payment. Use that extra money to go do the bid over ask that you need to help you get into that home.
Yeah, great point.
All
right, so we've given you a couple things to think about why we don't necessarily think that we're in a bubble, the next 12 to 24 months. But one thing that you like to mention, in the next 5 or 6 years, we believe there's going to be a continued shortage in housing due to a specific segment of the market that's now out there, the largest being the millennials, home buyers the oldest just turned 40. And we're probably going to see a 6 or 7 year run.
Yes.
On that generation that's looking to buy their first home and start their family.
Yeah, so I will give credit where credit's due on this one. A great mentor of the mortgage industry, Barry Habib, has been sharing with us as originators for the last couple of years that we're about to see probably the greatest run on new homeowners entering the market than we've seen since, I believe it's the 50s.
Correct.
Am I right on the 50s?
Going back a while.
Where the next 5 or 6 years.
The baby boomers.
It's the baby boomers.
So this is going to surpass the baby boom
run. Baby boomers. So, right now, the average age of a first-time home buyer, according to NAR, the National Association of Realtors, is 33. That 33-year-old buyer today, I believe, then was born in 1988.
Pretty good math.
And if you look at
the mortgage business,
the births chart, the next 5 to 6 years sees a significant increase in the number of births in our country. And so if that first-time home buyer stays at around 33, hey, listen, real estate agents, lenders, it's a great time to be in the business.
Correct.
You're going to have plenty of buyers coming into the market, for the next couple of years. And then, if you continue to look at it, you're going, well, Brian, when's that going to end? Well, if you continue to look at the chart from that, it stays pretty steady. We're going to see increases, right? I think all of us would be happy with a stable market.
Yes.
Right. By the way, that's what will come after the increase is still a stable market. So it's a great time to be a real estate agent. It's a great time to be in the mortgage business as well, because we're going to see some of our best years ahead of us.
Interest rates forecast in the next 12 months anyway to remain in the 3 range.
Yeah.
So
I did a presentation on Friday to a group of real estate agents with Brian P. Forrester, who we did an interview here on the Context to Contrast podcast as one of the top producing loan originators in the country. And anyways, him and I tag teamed a group of real estate agents, and he shared an interesting statistic. And I'm not going to get it completely right because it was his part of the presentation, but he had 4 entities. I think the Mortgage Bankers Association was one. The National Association of Realtors was another one. And there were 2 other ones that were giving forecasts on interest rates for the balance of 2021 and going into 2022. Nobody expects them to get over 4.
Correct.
Yeah.
Boom.
Crazy.
Boom.
Yeah. Crazy.
No more 6%.
So home affordability is here to stay for quite some period of time.
Yeah. So anything else we missed or you want to cover here before we wrap up? I mean, I think we gave 3 or 4 great points of why we don't anticipate any housing bubble.
Yeah, I think I don't have any.
I know it's hard to believe because I know for a lot of us that you might be out there in the market, maybe a trade up home, but if you're a seller right now, great time to be a seller and then a rebuyer.
Yeah. I really don't think anybody's going to end up in a negative equity position like we saw, in again in the late O's.
Well, we have more equity in housing than we have
Than we've
going
ever
back
had.
to 1990.
Yeah.
I mean, so it's phenomenal.
And part of that is because of those lending guidelines we talked a little bit earlier,
Right.
And you know, some things like that. But it's a great time.
Yep.
You know, and so I think, you know, hey, listen,
Inventory may see a little ease
And
here in
that's what I
6
was
to
gonna
12
say.
months. I mean, as we kind of wind down the forbearance stuff.
Yeah, there's a lot to be said for that, and that's where I was about to go.
Yeah.
Is, you know, we just don't know,
Right.
and the reason we just don't know is, you know, originally the CARES Act provided 12 months of forbearance relief, then it got extended to 4 months, an additional 4
yeah.
months. We don't know. Are they going to extend it more than that? We don't know yet. And hey, by the way, the other thing we haven't really considered is maybe they give some relief. Right?
Yeah.
I mean, the
modification.
government could
Yeah.
come out and give some relief to all of those folks
Yep.
who were in forbearance too. So we just don't know what the future holds in terms of that as we continue to, you know, work through this pandemic.
Yep.
But you know, the good news is that could provide opportunities to get some homes on the market. If I'm a real estate agent and I'm trying to create inventory, I think I would go the route of, hey, in forbearance,
Call me.
call me.
Yep. Call me with
Right?
questions.
Call me with questions, right? Because
I mean, know your options. If you're a homeowner and you're currently in forbearance, reach out to your lender. Reach out to one of us. We'd be happy to help you, give you guidelines. There are some, as you said, there's modification options for those families and folks that have hardship.
Yep.
You know, to the point where they can renegotiate the term, maybe put it over 40 years and drop some of that monthly PITI payment to make it affordable for them and their family.
yeah, absolutely.
So we don't, the last thing in our industry, real estate mortgages, we don't want to see anybody homeless.
No, we do not.
We're here to help get it modified and hopefully, you know, you can stay in the home.
And the truth is too, lenders do not want to own homes.
No.
They do not. They're not in the we want to own homes business.
We don't buy homes.
No.
No.
They are
We
not.
do not want to
So,
own homes. Yep.
So all right, well listen, John, nice job, bro.
You too, man.
Thanks for putting that together. So thanks for tuning in again to another episode of the Contacts to Contracts podcast. You know, if you like what you see, feel free to share with your friends. Make sure you subscribe so you know every time a new episode drops. And if there's anything John or I can do to help you out, please know.
Always
Thanks,
ready.
sir.